What we're going to do today is tax-efficient investing. And we are going to cover the lay of the land here as far as really how do you design an overall portfolio or wealth creation plan to be tax-efficient from an income tax perspective. So what we're worried about today is the income tax and the surtax, the AMT. We're not really worried about estate tax. We'll cover some of that on Friday when we get to the higher level IRA things. So where do we start? We start basically, the most important thing right now in today's world is bracket management. We have 6, 7 different income tax brackets. You have the AMT. You have 3 capital gain brackets. You have now this new 3.8% surtax, which we've been doing a ton of work on. As a matter of fact, Tyler in the corner there developed a little program that looks just like the form where you can actually figure out the AMT, or not the AMT, the 3.8%. And then you have the super bonus round where you're over $450,000 of income, where your tax rate on capital gains jumps to 20%, and your tax rate on ordinary income jumps to 39.6%. So these are all very important things. So really, think about this. A year ago, you were practicing in a 2-dimensional tax system. Today, you practice in a 4-dimensional tax system. But what we're seeing as we develop programs to look at this from a quantitative perspective, we're seeing the jump is not linear, meaning the knowledge just doesn't double, but it's more exponential. How this puzzle fits together, we have to look at it totally differently. So we have to have a quantum leap in our thinking, okay? And don't be afraid of that. One thing that I remember reading is that these quantum leaps can come very quickly if you work hard at it. Einstein had his 3 best quantum leaps in 1936, 1 year. If that year hadn't existed, we wouldn't know who he was. So just hope you have a similar quantum leap in the next 12 months. So we'll talk about these 5 tiers. First of all, we all know the income tax. Now the income tax, but what's important as we work through tax-efficient investing, the income tax is 100 years old this month. So you have 100 years of probably 50 different Congresses cobbling together the Internal Revenue Code. And that's why you have places where you can hide, like life insurance, like annuities, like IRAs and pension plans, like oil and gas, like real estate. So these things have all developed over time, and the smart investor can find tax shelter there. Now, a lot of my thinking on this evolved in the early 1990s when I looked at all these people I was doing estate planning for, and I said, how in the world did they all get to where they needed to see me for estate planning? And the common denominator, there were 2 common denominators. I had about 30 files on my desk at that point in time. I think 20 of them were real estate investors, and the other 10 were physicians with very large qualified plans. I represented absolutely no one at that moment who had just cobbled together a portfolio by day trading or by saving money in an outside brokerage account, because the tax drag is just too heavy, okay? So you want to try to find yourself tax shelter, whether it's real estate, whether it's the pension plan, whether it's life insurance. You need to find some shelter. Now, we have to deal with the AMT. The AMT has 2 different rates, 26 and 28 for regular tax purposes. But it also has a capital gain rate, which should match up with your regular capital gain rate. But that AMT rate is deceptive. And the reason the AMT rate is so deceptive is because as your income works through what's called the AMT exemption, for each additional dollar of income, you lose 20% of your AMT exemption. So the math is the real AMT rate for many people, and we'll see that as we work through today and tomorrow, the real AMT rate is more like 35%, not 28%. Okay, so if you're in that funny bracket, that's where you are. And we see that when we do our Roth conversion modeling, which we'll talk about a little bit tomorrow. 3.8% tax, I will spend some time on that today. This is by far the ugliest thing out there, and there's a lot of the gentleman drafting the regulations I've spent a lot of time with. He's been very helpful to the AICPA, and I've done a lot of teaching for them. But David Kirk is his name, and he's trying to create as much parallelism between the existing Internal Revenue Code and the 3.8% surtax. So, but we really have to, the biggest thing you need to know is for a wealthy client of yours, when you throw in the surtax, the top rate is now 43.4%. How do we get there? 39.6 plus 3.8 gets you to that 43.4. But that's not entirely true. Now, you work for a very large financial planning firm, and and you charge a fee, 1% or 0.75% to manage money, whatever the fee is. That fee, in essence, because of the 2% scale back on itemized deductions and the 3% floor, your fee really isn't deductible. Maybe in some circumstances it is, but we put it on the form, but it never really impacts the tax. Nor is your fee deductible for purposes of the surtax. So, let's say you got a 10% return and your fee was 1% for easy math. When you compute your surtax, you're not going to compute it on a 9% return, but on the actual 10% return because you're not allowed to take those deductions. So I think the real rate is probably somewhere like 4.1, 4.2%. Do you guys see what I'm getting at here? This is where, this is going to be very expensive. So we really need to put our shoulder to the wheel on the 3.8 and figure out how to plan around it. Life insurance, tax-exempt bonds, real estate, oil and gas. Those are going to be the things that make the difference. Or simply outrunning the 3.8%. Because the 3.8% on a married couple only applies when? When their income is over $250,000. Now, in all honesty, how many of you represent people that are actually retired, no longer with wage income, that have more than $250,000 of income? That's rarefied air. A lot of people have $250,000 of income when husband and wife are still working. They're both making $100,000. That's $200,000 right there. They have $60,000 of investments there in the surtax. You eliminate those wages, even if you replace them with a 60 or 70% pension, hard to get up to $250,000. Do you see what I'm saying? So you can outrun this tax simply by waiting till you're older before you touch money in annuities or touch money in pension plans. Do you see what we're going after? Okay. PEP and Ps, we'll talk about that a little bit. What we're talking about with PEP and Ps is really my wife and I losing our exemptions and our itemized deductions as our income goes over $300,000. And that phases out over time. Okay, that phases out over time. Now, 3.9 and 5% incremental tax rates, where do those come in for a married couple? $450,000, okay? And we'll have a chart, which I'll give you either today or tomorrow, which walks through all of these rates, where they apply. But the important thing for us today is to have our mind around the fact that we have all of these different tiers, okay? We have all these different tiers. And what you want to look for is an investment type that will affect all these in a positive way. Okay. Now, from 2008 or from 1980 through 2002, we were really looking at most of our planning was being done in a 3 to 5 year time horizon. But everything's changed now because you see, and I'll show you some graphs. I have a gentleman who I think he's actually meeting with me later in the week, in the evening sometime. But his deal is he's got a lot of money in an IRA. And when he turns 70, it's going to pretty much triple his income. But because he's been able not to take distributions, live off Social Security and a pension. And so now when we do his projections, we can't do them with all these different, with the 5 dimensions of the tax system now, we cannot do our planning in a 2 or 3 year time horizon like we used to. At the most, in 1990, when I started doing all this stuff, we were doing everything in a, basically a 1, 2, 3 year time horizon. Very tactical planning. If we take property taxes this year, how does that play out? It was just very small pieces around the board. The planning that I'm going to try to help you with today is to step back and look at this from a much longer term perspective. And that's not necessarily easy. But what you want to see is which way are our rates drifting? Okay, are they drifting up or are they drifting down? You have somebody that's working and they're going to retire in 5 or 7 years. Which way are their rates probably drifting? Probably down. You have somebody who's 65 and has $3 or $4 or $5 million in IRA. When they turn 70, their rates are going to drift up. Okay. Now, with all this said, our planning has to take into account all these different dimensions of the tax code. Does that make sense to everybody so far? Okay. Now, here's what we first have to have, is basically when you get over $450 for a married couple, $400 for a single person, you are in a situation where your income, is now going to be taxed at 39.6%, okay? Now, that rate is not altogether true because you're losing itemized deductions and you're losing your exemptions along the way. In the right circumstance, when you add all this together, the rate easily comes to over 45%, okay, on investment income. Now, on top of that, what else do we have to do? We have to throw in, on top of that, we have to throw in the fact that you're going to pay some state income tax. You're from Oregon. You have a state income tax of what, 8%? 9, okay. So now 45 plus 9 is 54%, no matter how you do the math. And you can say, well, Bob, you get an itemized deduction for your state income taxes, so maybe it's only 52. But, I mean, the point is over half of what your clients earn will be lost to these taxes. Now, the real complicated thing is we don't know if this is over, okay? I mean, big picture-wise, we do not know what the next Congress brings, or the Congress after that, or the Congress after that. People have talked about a Buffett-type rule where all your income would be taxed at 30% once you go over $500,000 of income. So, I mean, there's a lot of thinking out there on both the right and the left side of the aisle on how this should work. Okay, now capital gains. If you are in the 15% tax bracket, what is your capital gain rate? John? It's zero. That's exactly right. Your capital gain rate is zero. And that's one of the most important things to take into account. You'll meet my partner, Steve Biggie, tomorrow. And Steve represents well over 100 of these P&G guys. And most of them he can keep in the 15% ordinary bracket. That means their capital gain from selling the stock they took out of their pension plan is taxed at zero. Now, think about the pressure you take off the first 5 or 10 years of a person's retirement if they're not paying any federal taxes. They don't. Instead of drawing 100, they only have to draw 80. Well, that leaves more money in their portfolio. Does this make sense to you guys? So now, then we get into the 15% rate. When you get up into those higher brackets, then you go to a 20% rate. So the effective rate, 20 plus 3.8, the surtax, is going to be about 23.8%. That's not true because of the phase-outs. You're more like at 25.5, 26%. Does this make a little bit of sense to everybody? So these are things we really have to look at. Now, again, keep in mind how powerful, I think we missed this, how powerful that 0% rate is, okay? Okay, so far, so good, everybody? We're good? Okay. Now, phase out of itemized deductions. Okay, so what we know is you married couple goes into that highest tax rate at $450. Married couple starts to lose their itemized deductions at $300, okay? So at $300, you start to lose your itemized deductions. Now, there is PEP, which is losing your exemptions, and then there is Ps, where you lose your itemized deductions. Now, a lot of this can be done on software, but the problem with the current software is that it's very, very good in the hands of somebody who also has a calculator in their hands and a yellow tab of accounting paper, and you do all these side calculations. The software just gives you a raw data look at the tax return with no diagnostics, no analysis. Do you agree with that as far as the software we typically have out there? So what we did, all of my inspiration, but honestly all of Tyler's hard work, is we developed a program to make this happen. I'll show you some of that. Poor Tyler. We have this big project for the AICPA. We have it all done. We don't give him any credit. And I was proud of you, Tyler. You had the guts to send me an email and ask me if your name could be in that. So that shows courage. Now, here we go. PEP reduces your personal exemption by 2% for every $2,500 of income above the threshold amount. So as your income goes up, you start to lose your deductions, okay? I mean, this is just math, okay? This is just math. Now, so basically, by the time you have about $425,000 of income, you will have lost your exemptions. Okay, we used to have this, and it disappeared, now it came back. So on the tax returns we just did, we were able to use those exemptions. But going forward, we're going to lose those, okay? Now, Ps. Ps is worse. You start to scale back your itemized deductions based on 3% of your income. So let's talk about this. My income is $1 million. My P's limitation is $300,000. So $1 million minus $300,000 is what? $700,000 times 3%. I lose $21,000 of my itemized deductions. Everybody okay with that? Now, there's a cap on that, though, of 80%. So if my itemized deductions were only $20,000, I couldn't lose more than 80% of my itemized deductions, okay? So the software will do all this for you. Rarely do people run into the 80% limitation because people with $1 million or $2 million worth of income also have plenty of itemized deductions, mortgage interest, high state taxes, many times large charitable gifts. Okay, now, you do not have to scale back investment interest, medical expenses, or wage or any type of losses. Okay, so you do not have to scale those back when you do these computations. Now, when you're talking about all these limitations, though, the question becomes, how do we get income legally off your tax return? We do that with annuities, with insurance, with pension plans, with real estate, with oil and gas. Do you see what we're doing? We're looking, again, how long has Congress been working on the tax code? 100 years, 50 or 51 Congresses. So you have a lot of code sections out there that have been, I'll use the word cobbled again. They've been cobbled together over time. They're not symbiotic by any means. It doesn't work together, and there are places to hide. Okay, and that's really what your job as a financial planner is to kind of find those places to hide and making sure you're getting adequate returns in the meantime. I mean, investing in oil and gas to get a big tax deduction but not getting a good return doesn't make much sense. Now, and again, now some oil and I've seen clients with oil and gas investments. Oil is working. I want to be clear, especially because we're taping this. Oil works very well right now. Okay, because oil is obviously a global commodity. Natural gas, not so good because we've drilled too much natural gas. Oh, and you're from Pennsylvania, so you understand this firsthand. Okay. Now, P's, we start to lose our itemized deductions. Depending on your level of income, they're going to fully phase out someplace over $1 million worth of income. So for some people, this is a minor haircut. You have $310,000 of income, you're going to lose $300 of itemized deductions. Doesn't matter. On the other hand, as you move up, you'll lose more, okay? Any questions so far? So we're trying to build this foundation. Now, flying below the radar. There are I want you to imagine this tax planning like you would a radar screen. And you start, as long as you fly below 250, the 3.8% surtax doesn't apply. Okay, so we have to be below 350. Then you have this other limitation at 300, and then finally 450. Okay, now, the thing that this comes down to is we want to do everything possible to be here. Muni bond income will keep you down there. Deferring money in life insurance will keep you down there. Real estate that's sheltered by depreciation will keep you down there. Does all this make sense? Master limited partnerships will keep you down there. REITs with heavy depreciation will keep you down there. Does this, again, make sense? For some people, doing Roth conversions in bad income years, if you have somebody that has volatile income, maybe a farmer, that'd be the best example I could think of. In the years their income goes down, you may want to do some Roth conversions, and we'll talk a lot about that tomorrow probably. Okay, key management issues. We need to manage capital gain income first of all. Okay, so we want to manage capital gain income. That's important. And then we want to manage ordinary tax rates. In general, ordinary income should at least equal itemized deductions plus exemptions. So Steve, who does all these P&G, helps all these P&G guys, his clients will almost always just have capital gain income. Well, and then you have all these itemized deductions who are you get an itemized deduction of $20,000, but you're in a 0% rate. That doesn't make much sense, does it? So you need to at least fill up that bracket with enough IRA-type income, either through a Roth conversion or taking money out of an IRA, to offset those itemized deductions. Do you guys see a little bit what we're talking about? Now, tax liability should equal the credits available. I think one of the hardest things for a person, a financial planner who does not have an accounting degree, is to understand how all of these goofy credits move around, because of the concepts on how these credits move around are concepts that you pick up in an accounting class. Carry forwards, all these income limitations. Not to say it can't be done, but you as a financial planner need to really work hard to team up with the client's CPA to understand, if I do a Roth conversion, can we use any of that Section 42 housing credit? If I do a Roth conversion, will any of those AMT credits free up? Do you see what we're asking? Now, a lot of different financial planners approach this differently. Some financial planners are extremely quantitative, and they will do all of this themselves. And others are more coordinators, and you just have to figure out where you are, okay, what feels right to you. Now, this is off that software. This is a case I want to really illustrate. In this case, this guy's going merrily along way down here in something like the 15% bracket, or maybe the bottom of the 25% bracket. But what happens here when he gets to 70.5? His income goes way up. This happens every single day. Now, what's the smart move? The smart move is to at least pull your income up somewhere in the 28 or maybe 30, probably at least the top of the 28% rate along the way. Now, the other thing that's out there, and by the time some people are listening to this tape, it may not apply, but part of President Obama's budget, part of his solution to the budget crisis we're going through right now, would be to increase the insurance premium for Medicare paid by wealthier individuals on Medicare. So if you're making $2 million, your insurance premium is going to go up more than what you're paying today. Now, what does that mean for us in the short run? If that happens, everyone in this room may be scrambling towards the end of the year for their top clients to bring more income into 2013, a year where this doesn't occur. You know, if you're in the bottom of the 28% bracket and you got plenty of room, you might pull that income out forward so it doesn't apply in the future. Does that make sense? And the best way we've found to pull income forward is not to reach into an IRA or an annuity, but to do what? Roth conversion, because then you keep the money in a tax-deferred environment. Do you see what we're doing? Okay. Now, then, here's the problem this gentleman gets into. I'm up on the red slide here, and what we're going to do is we see that he's up in that 15% bracket, okay? I'm sorry, he's $15,000 into the 39% bracket, and then as time goes on, his bracket just gets higher and higher and higher. Is that making sense to everybody? Okay. Now, coming to this slide that's titled Income Tax Rate, what we're working with here is you can see 15% rate, and then you jump into the 39.6. Now, what's the point of these graphs? Here's where this all started. I'll just tell you what inspired us to do this. You know, every year, hopefully all of you go for a physical. And it used to be that the doctor would have to read a series of numbers on a page, which were all the tests he ran, which gave you numbers. And the physician, he or she, would have to have in their head what was the normal range. Okay? And they would have to remember all that, look at it, and apply it. That's how our tax software is today. The tax software all of you are using gives you raw data, which requires you to have a calculator in your hand and a chart in another to interpret all this. And then when I went back to see the doctor for the test, he had this really cool Mac application where it gave him a bell curve, and it showed a line where my test was. And there was, you know, basically green in the middle, yellow, and then red. Okay, so if you were in the red, you were in trouble. But as long as you're in the green, the doctor could just flip right through that. So instead of taking 5 minutes and thinking through all this, it took him about 30, 40 seconds to go through the test. That said, okay, I said we need something similar to that. And that's where why we developed this software, because I wanted to see where these rates were. Okay, I wanted to see where these rates were. I wanted to see where capital gain rates were on the sheet that says capital gains tax. Now, if you jump up to the next slide, I also wanted to see where I was, how much income I had in each bracket. So what this gives you is a quick diagnostic, John, of exactly where you stand and how you have to play this out. Does that make sense? Okay. Itemized deductions. Now, what happens on the slide that's titled Itemized Deductions? What happens when his income jumps? His itemized deductions plummet, right? His itemized deductions plummet because we're starting to experience the P's limitation. And what that means, if you take $13,000 minus $6,000, you're going to find out he just lost $7,000 of itemized deductions, and that probably cost him about 40% of that, $3,000 call it. Okay? So these are the things that, you know, we're looking at. And this comes down to maybe you time your itemized deductions properly to avoid this. Maybe you time your income properly. But there are things you can do. Now, most of this, the thing is, prior to the 1986 code, Tax Reform Act of 86, I started practicing in 82. Way back then, there were silver bullets. There were boxcar leasing. You could have a physician making $500,000 a year who would buy 2 or 3 boxcars, wipe out his or her income, and not pay a penny of tax. Now, the Tax Reform Act of 86 killed that. And if the Tax Reform Act of 86 hadn't killed that, what would have killed that is most of those deals, John, correct me if I'm wrong, did not make money.
That's correct.
And they made money for the promoter.
They were not designed to make the investor money. They were right on.
And that's the problem. I mean, with no economics, they wouldn't have lasted forever. People are doing that left and right. Tax Reform Act of 86 came and added what are called the passive loss rules, which we'll talk about. Passive loss rules mean there are some deductions you're not allowed to take. If you are passive in this hotel, and this hotel is losing money, you can't take those deductions. Okay, you can't take those deductions, and that's why we need to learn to read a tax return, because you might see that I have passive activity losses. I could have $2 million of passive activity losses, and I'm still paying income tax. And then the question becomes, what can I do to create income on that passive activity side? Because basically I'd be in a tax-free environment if I can absorb those losses. I have a client right now who has, I just looked at his tax return on the 14th. I think he has $60,000. Not a big deal. He's got $60,000 of passive loss carryforwards. So you wonder, how should he be investing? You know, his child wants him to put some money into a real estate deal, and I said, if you can get preferred units back where you stand right above the bank, to reduce your risk, that may not be a bad idea, because we can classify that income that's coming back to you as what? Passive income. So a PAL, P-A-L, is a passive activity loss. Have you ever heard that phrase? A PIG is a passive income generator. So if you have PALs, what do we want to find? We want to find PIGs. Does that make sense? So, okay, now this is, I'm up to my bucket chart. It reads tax asset classes on the top. This is very important conceptually. I want you to just step back for a moment and imagine, and Chris, maybe tomorrow, could we get this chart printed out on 11 by 17 for everybody? Or have Emily why don't you have Emily bring one back for everyone, just call her and see if she can do that. Starting on the far left is the worst type of income you can have. So, SJ, over here, if you're in interest income, even if you could find something that paid 5% and you were happy with that return, you're getting crushed because you're losing, a wealthy person is going to lose half of that income to tax. Okay? Now, as we move across the chart, we get into dividend income. Dividend income is how taxed how? You guys all know this. Qualified dividend, so we get capital gains rate. Now, then we have capital gain income. Here's the real beauty of capital gain income. It's not the rate, it's the deferral. Rate counts, don't get me wrong. Don't look the gift horse in the eye on the rate. But Chris, it's the deferral. It is not paying tax for the next 20 years. If you are a 29-year-old physician, young guy, I just saw, he's 29 years old, right out of school. Bottom line is, he's got to build a portfolio, right? But the core of that portfolio can easily be, his financial planners telling him, S&P 500 funds, Dow funds, boring. But what happens? There's no turnover, very little turnover, and he's in a tax-deferred environment. So in what we have to do, as tax rates go up, it requires more attention, not just on getting the pre-tax return, but on the after-tax return. Let me give you another example to think about. You represent the wealthiest guy in your town. He's in the real high tax rate. Maybe, and you run asset allocations as half stocks, half bonds. You run the same asset allocation for the poorest guy in town. It says half stocks, half bonds. That's flawed, isn't it? Because your asset allocation is done blindly without regard to taxation. You may want to make some adjustments. For example, if I'm the wealthiest guy in town, I'm willing to take maybe a preferred stock or a common stock that pays, for example, BP. What does it pay? 4.5%, 5% dividend? I might be willing to take that risk to get that qualified dividend rather than earn the same amount of ordinary interest. And those are adjustments you have to make, when you're putting together these portfolios. And keep in mind, most important thing especially for us to keep in mind is that 70% of this is good, solid investment decisions, and the other 30% is tax decisions that support that. Never lose track of that. Tax-exempt interest, obviously we're moving over towards the middle of the chart. The problem with tax-exempt interest is the rates are 60% of the ordinary interest rate. So you're not, or 65%, you're not getting that much for free because you're taking a haircut. Now, when we get into the world of tax-exempt interest, don't forget, some tax-exempt interest is really not tax-exempt. Why?
It's added back in for calculation of tax on Social Security and other items.
Social Security, and some of it gets, if you have an AMT preference bond, it gets added back for AMT. So this is a big deal. Now, then we get into pension IRA income. The question becomes, for a young person right out of school, should they be doing deferred pensions? Of course they should. They should pack in as much as they can. Should they be doing non-deductible IRAs if they can do that, or deductible IRAs? Of course. Or Roth IRAs? Absolutely. So if you're a young guy, Tyler or Matt's age, and our firm pays very well, so these guys can do this, they can put, you don't have to laugh out loud, Chris, but now they could do the Roth IRA, they could do the 401k. I mean, they can put as much away as they want. Now, the problem is, at some point in time, you can be too pension rich. And we see that all the time with physicians in their 60s, 70s, and 80s, where what's their only asset? I mean, they have a house, a boat, a car, golf clubs, and a $4 or $5 million pension plan. That's it. If that's how you land at age 65 or 70, there's no sense in even coming to see me except for Roth conversion stuff. Because there's nothing I can do for you because you only have one type of income. So the goal is to arrive at age 60 or 70 with what? Kind of a balanced portfolio, money in brokerage accounts, money deferred, maybe money in some Roths, money in some life insurance. We want to have a mosaic of assets. The challenge for the financial planner is that you're going to represent very few people from the time you're 30 to the time you're 70. Most people are going to stumble into your office at about age 60 or 65 and say, hey, I'm retiring, I've never done this before, what do we do? And they're going to have this mosaic of stuff they put together. And sometimes it will look real good and it'll be very tax friendly, and sometimes it's going to be all IRAs and tax deferred annuities, okay, which makes your job harder. Now, the best tax shelters available are kind of in this bucket here: real estate, oil, and gas. Now, on the real estate side, what makes real estate so attractive? What makes real estate so attractive is the depreciation tax shield. For example, you own this building and you lease it to whoever manages this hotel. You're taking depreciation over 39.5 years, or 39 years, excuse me. You're taking depreciation over 39 years, so every year you're getting about 2.5% depreciation. Now, if you leverage that up 4 to 1, for the dollar that you invested, you're getting about 12 cents of depreciation instead of 2.5 because you're leveraged. You guys see what I'm saying? And it's that depreciation you can hide behind. You can hide your income behind that. Now, that same thing, I guess, Chris, we should change this chart to put master limited partnerships up here too. Because does everybody understand how these master limited partnerships create the tax shield? I'll show you on the board here. Hey, Matt, do you think you could ask them if they have an eraser? They gave me markers, but no erasers. So, but let's say you invest in a master limited partnership. It's $30 a unit, and you receive a distribution of $3, 10% return, incredible return. Just for easy math. I know that's a rich return. But what might happen is, in a normal situation, if you had a $3 return times 40% tax, you'd pay $1.20 in tax, and you'd have $1.80 left. Everybody agree with that? Pretty easy math. Now, imagine instead of that, you have your $3 of cash, but your income is only, say, $2. Now you're paying only 80 cents of tax. Many times in the initial years of these partnerships, what they're doing, it's very simple. They're depreciating the pipeline. Okay, they're depreciating the pipeline. That depreciation shelters your cash flow where you don't pay income tax. Now, that is what we call a timing difference, not a permanent difference. A permanent difference, for example, would be a tax credit. Okay, that is a permanent thing that you can use. A timing difference, John, is you get depreciation in year 1. But by year 6, depreciation's gone. And by year 12, when you sell, you have to recapture that depreciation. So all the master limited partnership is doing is giving you deferral. However, if you represent a 60-year-old physician and she wants to put 5 to 10% into a portfolio master limited partnerships, and then she's going to sell them after she's retired, this may be a very solid tax shelter. Do you see what we're saying? Now, the problem with all these tax shelters, whether it's oil and gas, maybe REITs to a lesser extent, master limited partnerships, is the market is not efficient or not as efficient as you would have with Coca-Cola, Boeing, McDonald's, Dow 30 stocks, or even S&P 500 stocks where everybody knows or thinks they know what's going on. Okay, you're moving further away from where there's clarity and visibility. Do you see what I'm trying to say? So you got to be careful. I see people come in and they have 80% of their net worth buried in one of these tax shelters. And it's great from an investment perspective or from a tax perspective, maybe not so good investment-wise. Okay, far side, the best place to hide. Wow, thank you. The best place to hide is going to be in your Roth and your insurance. Now, so when we talk about Roths, there are 3 ways into the Roth. First thing you can do to get into a Roth is you can do a Roth contribution if your income's low enough, right? That's low-hanging fruit. Second thing you can do, if your income is too high, what's the next trick? We do a non-deductible Roth. We wait 6 months to 9 months, and then we flip it into, or we do a non-deductible IRA, and then we flip it into a Roth, okay? Now, the IRS is starting to challenge that. So what you don't want to do is engage in a step transaction. January 1st, you put money into January 2nd, you put money into the Roth, or into the regular IRA. Regular IRA on January 2nd. January 3rd, you convert to a Roth. How many of you think an IRS agent might be concerned about that, right? Probably legal, but you cannot, on a $6,000 or $6,500 investment, you can hardly hire me or Michelle or Steve Biggie to defend that with the IRS. You're just going to have to cave. I mean, you're just going to say to the IRS, you're right. What do we do now? On the other hand, if you wait 9 months, 6 months, a year, you have an argument that those steps are far enough apart that they can't be collapsed. Do you see what I'm trying to get at? But anecdotally, the IRS, what I've heard is the IRS is starting to look at this stuff. And that's, maybe they should be looking at it. I don't know from a policy perspective. But I think if Congress doesn't want you to be able to do that, Congress should say that. And Congress did not say that. They created, in essence, what people often refer to as a loophole. Okay. Now, insurance. You have a client that wants to be half in stocks, half in bonds. He and his wife are in the 50% tax bracket. They're in good health. They're 55 years old. If they can get insurance, on a standard plus basis on second to die, you're going to be able to create a pretty good tax shelter for them. Now, we can use single life insurance, just on one person, but what's the advantage of second to die over a single life? Yeah, it's lower mortality because, see, if I have to insure anyone in this room, the actuary says, okay, there is this % chance you die in a car accident, this % chance you fall off your roof. There's all these chances, everything that can go wrong, right? But what is the odds of both H and W being killed in some common accident? Non-existent, right? That's why it makes the news, okay? So, the actuaries are not going to worry about it. They're going to know one person will live to a normal age. They don't know who it is, but one party will live to a normal age. So they're not going to pay to that second death. That's why second to die makes sense, okay? Why do we want to be in the insurance? Because how can you make money? Let's say you're making a 3% return on your bonds, but you give half it to the government. You're only making 1.5%. On the flip side of that, if it's all in an insurance policy, you get to keep that whole 3%. And then when the couple dies, all the death benefit is tax-free. Now, this is especially important on the insurance side when we're dealing with a family trust. Because a family trust, John, you represent some trusts, which we're helping you with, and that is, the rate is 43.4%, period. Now, you can pay money out to the child, and that eliminates that, but that's the rate, okay? So that's where insurance can make some sense to the tax shelter. Okay, now, with this chart, I would submit to you, if you knew the language, you could take this chart, go anywhere in the world, sit down with whoever does tax work in that country, whether that's CPAs or lawyers, whoever it is, and have them teach you about their financial and tax system using this chart, and you would know how to tax efficiently design a portfolio. Now, my guess is that you went through this chart today with me in a half hour because you all have 15, 20 years experience. So it would take longer. But this chart is a framework to think about how to position some investments. Because what we're going to see later is when I get to be 65 or 70 and start drawing money out, I don't want to have everything in just one basket. I want to be in many baskets. So if you think about what do we do with a portfolio? The Old Testament wisdom, which has been refined by people at Wharton, is not to have all your eggs in one basket, right? I mean, all the University of Chicago people did in the 1970s was take Old Testament knowledge and use mathematics to quantify it, to make it work in our environment today. The same thing kind of applies in the tax world. Once you get your investment set, you have to figure out which bucket is going to give you the best tax result for that particular investment. For example, if I am 55 years old, I'm making really good money, I'm half stocks and half bonds, I want my bonds where? I want my bonds in my pension plan. And where do I want my S&P 500 fund? Probably in the palm of my hand because it's not going to generate much taxable income. Does that make a lot of sense? Now, here's the real good news. From a financial planning standpoint, if you can, here's where people can really make a nice career for themselves. Doesn't matter what profession it's in. Really, the tax stuff traditionally has been done by who? Let me write this differently. Tax stuff's been traditionally done by CPAs, right? And the investments have been done by financial planners or CFAs or whoever, right? What happens is you get to this intersection point where most people do not want to venture into because it's too complex. And that's why you're here today, because you're showing an interest or willingness to venture into this. So we want to venture into this, and if you can do that, I've been in dozens and dozens of meetings, probably well over 100 introductory meetings with financial planners where the clients are interviewing them. And they're all the same. Talk a little bit about tax efficient asset, or talk a little bit about, the efficient frontier, portfolio management. We'll do this questionnaire. I mean, they're all the same. Every one of the messages is kind of the same. And clients really don't understand how you're going to create alpha in their portfolio, nor do they necessarily believe you can. Okay? But when you start saying, listen, I cannot beat the market statistically. We're going to have a hard time beating the market no matter what we do. But what we can do is we can take your income tax return and we can try to time things and fine-tune things so that you are going to receive the best after-tax return possible. For example, in the first 5 years of your retirement, we'll sell stock rather than taking money out of your IRAs. We'll do some Roth conversions. Do you see what I'm saying? You build upon this, and that's where you're going to add value. Because what I see is the financial planners that seem to have the best practices, biggest books of business, are making sure that they're active in this intersection.
In this extremely low rate environment where we're not making much money in hardly any areas, tax planning now becomes much more significant than it was 10, 20 years ago.
Yeah, the comment to us is in today's low interest rate environment and really low return environment in the stock market, tax planning is much more significant and rates are higher.
Yes.
So, and what we're going to talk about too is, you see, we'll talk about charitable trusts as we work through today, but charitable trusts were not very popular under President Bush because the rate was 15%. And most people are like, I don't understand this. I'm never going to understand it. I'll pay the 15% and move on. Because I get to keep 85% of my chips. But suddenly, when you only get to keep 75% of your chips, there's an elasticity where, I'm in pain here. What can we do to keep that capital working for me? So we'll talk more about that. Okay. Now, so this intersection thing is really important because as we work through tomorrow and Friday when we're talking about the IRA stuff, we'll see another intersection point, and that's the intersection point between the income tax planning and the estate planning. And the reason the IRA planning is so difficult is because it covers both what lawyers learn in law school and what CPAs learn in their master's degree in tax. And the problem is very few people have the skill set to cover both. And so most people just stay out of it, and that's why there's a big gap in knowledge. Okay, we good with this asset, with this chart? Okay. Now,